Benjamin Cowen of IntoTheCryptoverse sits down with Gareth Soloway of In the Money Stocks to discuss Bitcoin and the altcoin market. Ben, who shares a lot of on-chain analysis, mentions that there could be a direct correlation between the price of Bitcoin and the overall health of social media channels that specifically discuss crypto. And that when social traffic amongst crypto content creators is down, the price of Bitcoin and altcoins is also likely down, or when traffic is up, price action tends to be up.
In pre-halving years, but one interesting thing to clean this up a little bit is to take, say, like a 30-day moving average, right? And here it's when you start to spend a long time trending in the wrong direction, price normally does resolve in that direction, right? Yeah. It's like if you keep trending higher on the social risk for a long time, it doesn't mean that price can't go down in the short term, but eventually it resolves higher with the social risk. If it keeps going lower, then I would assume that eventually the price would resolve lower, more so in line with the general sentiment of the cryptoverse. I'm curious though, I mean, what are your views on this? My general thought, of course, is that if you spend a lot of time at these levels, it's a good sign, but we're still trending down to those.
Down. Yeah, and what's interesting here too is, like you're saying, prices actually of Bitcoin has moved higher. Obviously, alts have gone lower in general. But also the thing that I would kind of take note of is that it doesn't look like we're at the levels that we saw in 2019 and 2020 yet. We still have further downside to go as well. And the first thing that jumps out to me would be saying, okay, well, during those periods, you had quantitative easing, right? So there was Federal Reserve printing money, interest rates were lower. We now have a scenario where we're still above that level, those bottoms, but we have liquidity being sucked out of the market. So in the very least, if it was just me, I would say likely that social index should get down to those lows, if not go a little bit lower than what we saw then because of the lack of liquidity.
Right. But, I will say we're getting close, right? I mean, it's, you give it a few more months. I think we could see this thing ultimately bottom out. And one idea too, Gareth, for the social risk is maybe it's a better indicator for the altcoin market, right? Rather than specifically Bitcoin. Because, the social risk has been going lower, but altcoins have also been going lower, right? A lot of them have already put in new lows. So yeah. I'm thinking maybe the social risk is a great indicator for when altcoins become worth the risk.
Ben goes on to discuss that according to the Total 3 chart, which is essentially the altcoin market, we potentially have another 40% drop that could occur in the next couple months. This would reflect what the 4-year cycle has done in the past in pre-halving years, and would result in a final capitulation in altcoins. Ben concludes this would bring further rise to the Bitcoin dominance and would finally bring altcoins back to their fair value.
I think it's really interesting how well this stuff works out. So this is Total 3, so the altcoin market minus USDT market cap divided by Bitcoin. And you'll see that alts tend to top out at parity with respect to Bitcoin, right? When the altcoin market cap equals the Bitcoin market cap at 1, that's where they tend to top out. And where they tend to bottom out is around 25% of Bitcoin's market cap. So I'm looking at this and I'm saying, all right, well, altcoins are currently 42% of Bitcoin's market cap. What happens if we go back down here? That's another 40% drop, wow. on their Bitcoin pairs, right? On their Bitcoin pairs. And the other fascinating thing about this is roll back the clock exactly 4 years. We were at the same valuation. All Bitcoin pairs were collectively at the same valuation in July. And then by September, they had dropped that 40%. Again, this is a little bit different than what you're talking about because you're looking at their USD valuations, right? And their USD valuations can do all sorts of things, but it's always, what is their Bitcoin valuation doing, right? And are they getting wrecked against Bitcoin? Are they not? And I think the reason I look at this is because I want to know, when does the altcoin market become a better macro investment, right? Because you're looking at the short-term stuff, right? You're looking at the short-term play. How can I squeeze as much out of this? Because it's like, you have to trade with what you're given, right? If you're given an altcoin bear market, you trade the altcoin bear market. Yeah. But I'm trying to figure out, like, when does the altcoin market finally become worth the risk? And I mean, could be within a few months.
Yeah, and I think that's where I'm leaning, is that I really do think, and I think I even said it last time, is that the alts at some point will be able to figure out their valuations once we get clarity from the SEC, right? And so the SEC will say, okay, these are the rules, and then all of a sudden big money will be able to start valuing these things. And so whether, the market caps on a Matic should be 5 billion or 25 billion or maybe 50 billion, we don't know yet, because again, we don't know what the real valuations are, but that will become clear. And my guess is at that point, that's where the value really starts to, and by the way, that's actually a good thing. Like investors need to understand that any sort of additional information that these coins can give us makes the clarity and the transparency much better, which allows us, even as retail investors, to say, okay, I think I should pay here for this versus where it was before. And I think that's important for us.
Finally, Ben and Gareth conclude that there is a real issue with liquidity in the markets, and that historically when price action moves up while liquidity moves down, the markets typically resolve with a major correction. These divergences can be seen in the charts going back many years. The questions to ask ourselves are, if we get a major correction, how low will we go? And lastly, how high do we go before we start to correct?
If you look at this chart, we've talked about this a couple times as well, right? This is like global net liquidity, or an approximation of global net liquidity. I mean, the jaws have opened, and it's hard to know how long they stay open before they clamp shut. I mean, last time they opened back over here in December 2018, they didn't clamp shut until about 14 months later. But in 2018, when the jaws opened in April, they clamped shut. They started the process of clamping shut only 6 months later, right? So it's really hard to know how long the market can climb the wall of worry. I'm guessing it will climb the wall of worry until it has reason to not do so, and that normally that reason is the labor market, right? Like, until the labor market goes, it loves climbing the wall of worry. It doesn't mean that it won't have any pullbacks, right? But and if you look at charts, I'm actually I'll try to.
And just one thing to just mention, and a couple of things. So this divergence, the jaws, to me right now look much steeper than in the past. I don't know if you can go back again and just see, but to see how the divergence was much at least the yellow line is much more gradual.
Right.
But the other thing too is I'm noticing is the market made new highs in each of those instances. So it just in each of those times, it looked like it was a new all-time high.
It did. I mean, it in both of those cases, it did. Again, it doesn't always, but in both of these cases, it did make new highs. But you're right. I mean, like, global net liquidity back then wasn't going down as much. I mean, to give you an example, right, from this high here, global net liquidity was at like 21 trillion, and then it went down to like 20 trillion. Like, not a huge move. Look at it today, though. I mean, just in the last couple of months, it's gone from like 28.5 trillion to 26.5 trillion, right? Like, it is now, maybe as a percentage, it's not as bad, but I mean, that's where we currently are, right? And people, if you're wondering, like, why is it going down so quickly, you have so at the beginning of the year, you had, or late last year, you had China reopening and Japan, right? You had Japan and China printing money. Now both of their balance sheets, I believe, especially China's, they've been going back down. Like, if you look at the Bank of China. But this big drop in net liquidity that we had last week is courtesy of the ECB. In fact, they're actually starting to become more aggressive. They talked a few months ago about increasing their QT come July, and now it's July, and they put their money where their mouth was, and they've continued to sort of tighten here. And the Fed is going to keep doing what they're doing. So I think you make the case that they're likely going to just continue this as long as it takes, right? Like, they're going to do it until it leads to, my guess is they're going to do it until asset prices finally take notice.
If Ben and Gareth are right about the markets, we could see a significant pullback on Bitcoin and the altcoin market over the next couple months. With that said, we are another day closer to the halving, and another day closer to the bull run. Thanks for watching, and stay tuned for more content regarding the crypto markets. Please like, subscribe, and we will see you next time.